Capital Group, and hopefully some people will join, catch us there. We also, anyone who can't join the webinar will go, will be pushed there as well. All right, well, I'll get started with a quick introduction here, and then I'll hand it off to you, Brittany, to get started here for the night. And we'll allow more people to jump on as we get started here. And my name is Aaron Fragnito with People's Capital Group. We're doing how to self-direct your IRA into real estate tonight. We're also going to talk about investing in real estate with a self-directed IRA, which is Brittany's part here with Next Generation Trust. So she'll be able to talk about that. And Next Generation Trust is a self-directed IRA custodian, so she'll focus more here on the self-directing part of the process and when you're self-directing your IRA into real estate, and I'll focus more on the real estate part of the process when you're self-directing your IRA into real estate. And so Brittany will go first here, then I'll speak for about 20 or 30 minutes as well. Overall, it'll be about a 45-minute, hour-long presentation. Brittany's presentation here in the first part will open up for questions when she's finished here. And if we have any questions as we go along, please type them in the Q&A. All right, here's the Q&A here. So that's always good. We'll keep an eye on that and allow for questions at the end of Brittany's presentation. And then we'll do my presentation. We'll go for questions after that as well. And we're also live on Facebook here at the Real Estate Investments Facebook page. And we'll be on the People's Capital Group Facebook group as well. But without further ado, Brittany, I'll hand it off to you and you can get started here for the evening.
That sounds great. Thank you, Aaron, for having us on tonight. My name is Brittany Melville. I'm the Director of Marketing and Sales with Next Generation. As Aaron said, we're a self-directed IRA custodian. So I'm going to share with you some educational information tonight, and then Aaron will dive a little deeper into the real estate side of things, but just wanted to cover conceptually, if you were interested in making these types of investments, how you could do it through a retirement account. I also have here with me my colleague, Jack Malpass. You can see him on the screen. He is on our business development team, and he is heavily involved in helping investors become educated and setting them up with their own self-directed IRAs to get started. So with that, we'll jump right in. Quick disclaimer, although we are a self-directed IRA custodian, we are not advisors, so we're not fiduciaries, which means that all the information that we're sharing tonight with you is for educational purposes only. It's not intended to be financial advice or an endorsement or recommendation of any particular investment products. So for anyone who maybe isn't fully familiar with self-directed IRAs, maybe you've heard about them through others that you know, through investing, through friends, family, etc. What makes a self-directed IRA unique is the ability to expand your investment options. So most people think of IRAs and they think stocks, bonds, mutual funds. And they think that's kind of where things end. But with self-directed IRAs, which have been around since the 1970s, and most people just don't know that, self-directed IRAs allow you to invest in what we call non-traditional assets, so those that are not traded on the public markets, and using your retirement account as a vehicle to make those investments with the same tax advantages that would come with a regular IRA. So those tax advantages, of course, would be deferring tax on your earnings if you have a tax-deferred IRA, or eliminating the tax obligation altogether if you have a Roth IRA. Additionally, with the self-directed IRA, other than just expanding your investment options, you have the ability to hedge against the market volatility because these types of assets tend to be non-correlated with market activity and yield more stable returns over time. So if you think about it, it's also sort of a way to diversify your portfolio beyond just your public securities that most people think about. Additionally, if you have interest in specific investing areas like real estate, which we're going to talk about tonight, and certain things that you're passionate about or maybe have experience in and have been very successful, you can take those same approaches and knowledge and apply them to investing through your retirement account to ideally have a little bit more control over the return on investment that you're yielding, and of course we're all looking to accelerate our wealth building over time and accelerate and maximize our investment return. So this is just yet another strategy that you can consider to be part of your overall retirement planning approach. So we talked about non-traditional investments. What does that mean? So within a self-directed IRA, you can invest in real estate, the biggest one, and we're going to talk about that in more detail. But even within that category, you have buy and holds, you have fix and flips, you have residential property, commercial property, you have multifamily, you have syndications where you can have more of a passive, minority interest in a project. And then, of course, there's private lending, private equity, so investing in startup companies or other private entities, hedge funds, even pre-IPO companies. You can form partnerships with other self-directed IRAs or just other individuals. Cryptocurrency is allowed in self-directed IRAs, and there's been a lot of interest in that lately. And social and impact investing, I talked about things that some people are passionate about. That's another area for consideration. So just about anything you can think of that's not publicly traded could potentially be held in a self-directed IRA, with the exception of life insurance and collectibles. So a lot of times we get the question, okay, how does this actually work so that if I'm taking the money and I'm using it for real estate, for example, I'm not having to pay penalties or having to pay taxes when the money comes out of my account. So the way that it works is you're not actually taking the money out and holding it yourself personally when you're doing these investments. You're working through an IRA custodian, an IRA administrator that's going to be sort of that middle party in between your account and the investment. So while you have a self-directed IRA, you have control and ability to choose your own investments and then direct your custodian to process the investment transactions on behalf of your IRA. So you're not actually going to take a withdrawal, but you're going to direct the custodian to deploy the funds to ABC Investment, for example, and then they're going to take the cash out of your IRA, send it over to the investment, and then as you yield return, those earnings are going to flow directly back into your self-directed IRA, thus giving it that tax shelter and those tax advantages. And then, of course, when earnings flow back into that account, they can be reinvested in a new project. They can be invested into the existing project if you wanted to add capital to what you're already doing. You could transfer them back to another account to do stocks and bonds again. Or if you want to start taking distributions out, if you're of retirement age, you can do that. So you have a lot of options and a lot of flexibility within the IRA. In terms of the actual logistics and getting started, if you've never done this before, there are three main steps in the process. Of course, the first is going to be if you don't have a self-directed IRA and you have, just an IRA, for example, with Fidelity or Schwab or Morgan Stanley, you do need to establish a new IRA with a self-directed IRA custodian. Most of the large brokerage houses don't offer self-directed IRAs. They specialize in stocks, bonds, mutual funds, etc. So typically, if you have accounts with them, you're going to have to look elsewhere for this option. And that is what Next Generation, for example, does. We specialize only in self-directed IRAs and non-public assets. So opening an account, you just obviously fill out an application, but you do have to decide what type of IRA, even though it's self-directed, you'd like to have. So you can still have a traditional tax-deferred IRA that you self-direct. You can have a Roth self-directed IRA if you're a business owner. There are a few other options. You can do a SEP, you can do a simple, you can do a solo 401k, which many people would be familiar with if they have their own business. And that allows for some additional flexibilities as well, and those can be self-directed. So there are a lot of options there to also think about and educate yourself on the different account types. So once you submit an application and open your account, then of course you need to get funds into the account to start investing. So from there, you have a few options as well, and it depends on your situation. So if you have an existing IRA elsewhere, like I mentioned, that doesn't allow for these investments, then you can do a transfer from that entity, from that institution over to the new self-directed IRA. That's not a reportable or taxable event. You can do as many transfers as you like. If you have an old employer plan, like an old 401k that's inactive, you could usually roll that over into an IRA. So that's another option. If you've left a job, which many people have, excuse me, if you've left a job over the past year or two, you could do a rollover. And then you can also make a contribution out of pocket. So especially for those plans that are designed for self-employed individuals, there are high contribution limits. So you could essentially take money out of your checking or savings and deposit that into the IRA to build up that value. And the custodian will work with you on doing all of that. That process can take several weeks. As you can imagine, trying to get funds out of another institution is not always the easiest thing to do. They're not always rushing to let go, but you will work with your custodian during that process. And then finally, making an investment. Depending on what type of investment you're looking to do, that's going to involve providing some paperwork to the custodian. It's going to be a direction of investment, which is going to tell them what you want to invest in, how much, where to send the funds. And then there's also going to be some supporting documentation related to your investment type. So the custodian will need to look at that because they want to understand exactly what you're agreeing to invest in and what your IRA is going to be bound to and what should be expected from that investment. And it's also important that on all of that paperwork, the name of the investor be your self-directed IRA with your account number and not your personal name. For tax purposes and reporting purposes, all of that should be distinct. So the custodian does a very thorough review of all that documentation. If they catch anything that would be, which I'm going to talk about in a moment, considered a prohibited transaction, they would halt the transaction and not allow the investment to continue in order to try to preserve the tax advantage status of that retirement account. So everything is done with keeping that benefit in mind. So I just alluded to prohibited transactions. So while all this is very exciting and there are a lot of creative things you can do, there are some limits to be aware of. And these are set by the IRS, so we don't mess around with that. But it's important to understand that a transaction between a self-directed IRA or self-directed retirement account and what they call disqualified person is prohibited. So disqualified persons are any of these individuals that would have a relationship to you if you had a self-directed IRA, for example. So yourself, any spouse, A sentence, D sentence, and their spouses, anyone that's providing a service to the account, could be an attorney, could be a CPA, could be a financial advisor. Those individuals cannot do investment transactions, meaning they can't be investing directly with your IRA. And then any company or entity that is majority owned by any combination of these disqualified persons, you would not be able to invest in. So an example of that might be if you wanted to invest in a company that your spouse owns, you wouldn't be able to do that because your spouse is a disqualified person from your IRA. So just keeping that in mind and understanding that it's important to be aware that there are some restrictions and some limitations. It's important to lean on the custodian that you're working with to provide you more education on that, so that when you're looking at investment options, you're keeping that in mind. And also understanding that the consequences of that can be pretty steep. So you just want to make sure that you are keeping communication open with the IRA administrator to make sure that everybody's on the same page as far as what's happening with the account. A couple examples of prohibited transactions specifically in real estate would be, for example, buying a property with an IRA and then trying to cover expenses out of pocket with your personal funds. Trying to do sweat equity on the property, like physically going to the property and trying to make repairs or doing upgrades yourself. If your IRA is involved in the investment, you would be hiring a non-related contractor or a third party to do those types of repairs and that type of work. You also are not able to let any disqualified person, so those relationships I mentioned earlier, live in the property, use it or rent it, or provide services as well. And then, of course, if you're selling a property or buying one, you can't be doing that transaction with a disqualified person as well. And the reason I mention this here is because I know Aaron's probably going to talk more about some real estate investments, but when we look at what types of investments generally tend to bode well in terms of keeping people away from the temptation to do these things, it's usually passive real estate investments where you're sort of hands off, right? And you want to invest in real estate, but you don't want to be too involved and actively trying to manage everything. So, getting into things like syndications or partnerships, where you can be an LP and kind of let somebody else manage the project, bode well for this because you're not really exposing yourself to the risk of doing these things as much as you would be if you were buying a property and holding it yourself. So I just wanted to mention that just to keep that in mind. And of course, for a lot of people that are still working, if they wanted to have a self-directed IRA and invest in real estate, they might not even have the time to manage all that anyway. So the passive investments can be very fruitful for these types of setups. And if you were going to do something like that, investing, in a partnership or a private entity using the self-directed IRA, some of the documents that I mentioned before, I alluded to supporting documents. Some of those that you would need to provide your custodian would be operating agreement for the LLC that you're going to invest in, either a certificate of good standing or articles of formation to show that this entity was formed and where and how long it's been in existence. And then if you would typically, as an investor, sign something like a subscription agreement or a private placement memorandum, those things also have to be filled out and reviewed by the custodian, but of course it's going to be in the name of the IRA rather than a personal name. And then the custodian will review and sign on behalf of the IRA to authorize that transaction. So I just wanted to throw that out for you to get a sense of, if you were to really do something, what's expected. And then, as I mentioned before, the process can take several weeks. So it's always good to be proactive and educate yourself and understand what this might look like if you think in the future it'd be something that you'd like to do. Better to feel good about it before identifying an investment, so that you're sort of set up and ready to go if you were to move ahead with something like this. So I want to give Aaron more time to talk, and I think we had a few minutes for questions. I'm just skimming the surface here tonight. But if anybody has questions, I think we do have a few minutes, and then I'll also drop a link in the chat before we're done tonight with more ways to get in touch and access more educational resources on this. So thank you.
Thanks, Brittany. We have a question here in the chat from Melody, if you want to read that.
Okay, let's see. Okay, so Melody says, I took my Fidelity employer 401k and put it in a self-directed IRA. I didn't want it to sit and not earn while I was looking, so I put the money in silver and gold. Okay, so precious metals. Now I want to take that, use it for real estate, and don't know how to proceed. I suspect I just need to talk to my self-directed IRA custodian, which is the middleman, and I can then use money to finish a rehab that I paid cash for and put my own money in, but need more for finishing the rehab. Okay, so I think there are two pieces to this. The first piece is that the self-directed IRA is already invested in something, and now the investor wants that cash for a different investment. So the first thing that you could do there, if you have the money in silver and gold, is sell those precious metals to liquidate your investment and get that cash back into your IRA. So once you have that cash back, and yes, you're correct, you would have to contact your custodian to help facilitate that transaction to sell it. And then once you have that cash sitting in the account, you can put it into a new investment. However, from what I'm reading, if it's a property that you've already paid for and you own personally, you're not able to use the IRA to then contribute funds to finish the rehab. It would be a prohibited transaction. If you knew of another, maybe a way that a self-directed IRA could come into play here is if you needed to borrow money, someone with a self-directed IRA could lend you those funds to finish the rehab and you could pay them back. But at the point that you've already purchased the property, it's too late to contribute more funds. So I hope that clarifies a little bit. I know it can get tricky with different situations. Okay, and then the next question is, what is the minimum that you can lend if somebody wanted to borrow? There are no minimums. The beauty of a self-directed IRA is it's completely free for you to decide. It really ends up being between you and the borrower, or you and the lender, depending on which side is doing what. But of course, you would just want to make sure that you're comfortable with the terms of whatever note or whatever loan you're going to strike up. And then that paperwork, of course, has to be submitted to the custodian to review, and the terms should be reasonable in order for an IRA to be able to do it. But there technically is no minimum. One more question: where is the best place to go to find self-directed IRA holders that are willing to lend money? That's a great question. So, I mean, I would think that any real estate investment groups, you're going to find people that have self-directed IRAs. That's usually, I think the real estate community was probably the first group that really adopted the use of self-directed IRAs. And I think now we're seeing more leaning toward the private equity side, a lot of more people getting involved in that with IRAs, but certainly real estate investing communities. Also, if you connect with self-directed IRA custodians, there may be opportunities for you to network with their communities as well, which would include their clients that are already using IRAs and they may be looking for investments. So I would say, definitely keep those lines of communication open with those resources and ask. I think sometimes just even asking the question, you'd be surprised how many people would know and have experience, but it's not something that everyone talks about all the time. So until you know to ask the question, you might not necessarily know what opportunities are there in front of you. Okay. I think we're good, Aaron.
If I could also add, connection was a little bit slow here. Can you hear me properly?
Yeah, you're good.
Okay, awesome. So yeah, I would also like to add to Melody's question there. If you own a property with cash and you don't have a mortgage on it, any hard money lender is going to be willing to give you a loan to finish the rehab on the property, as long as the loan amount you're asking for isn't more than like 65, 70% of the property value. So I would suggest talking to a hard money lender as well. And that could be a good way to go about that. But all right, I'm going to jump on and grab the screen share here. Okay. And all right, we'll get started. Thank you so much, Brittany. I always enjoy doing our presentation here. I've known Brittany now for a number of years, and it's always good to get that side of how to self-direct your IRA into real estate, the self-directed part there. And they're a great group to team up with. So if you are looking to self-direct your IRA, go with Next Generation Trust. They're a great company, and I would definitely suggest working with them. I've helped many clients self-direct through them. So good experience there overall. And so I'll focus here on the real estate end of how to self-direct your IRA into real estate. And I know we got a bit of a late start here, so I'll be pretty quick. And if you have any questions as we go along, please, of course, there's Brittany's information to get in touch there, Next Generation Trust. And so you can reach out to her there. Her information's in the chat to get in touch with Next Generation Trust and Brittany there and her group. So I'll speak for about 30 minutes here on the real estate side of it. And this is not a solicitation for funds, tax advice, or legal advice. We're going to break into how we help people passively invest in real estate, how they self-direct their IRA or solo 401k into real estate using an IRA custodian, and why about a third of our investors here, People's Capital Group, choose to use their IRA to diversify some capital into real estate, generally out of the stock market, into real estate, why people do that, why we do it with apartment buildings, and the strategy we have, the buy, renovate, refinance strategy. So we'll break into all that tonight. And of course, this is People's Capital Group. You can get a copy of this presentation as well at our Facebook page, Real Estate Investments, or our Facebook group, which is a private group, People's Capital Group on Facebook as well. But our mission is to transform personal finances and quality life by creating passive income streams through real estate investments. So that's our mission at People's Capital Group. And I actually got into this business about 10 years ago with my business partner, Seth Martinez, because I read a book when I was graduating college called Rich Dad, Poor Dad, as many people have read. Amazing story. If you haven't checked it out, definitely read that book. And in that book, I learned, here's a quote from it: the moment you make passive income and portfolio income a part of your life will change. So for the last 10 years, Seth and I have helped dozens of people passively invest in real estate, many of them using their self-directed IRA or solo 401k. We got started in 2013. We incorporated, but we've both been working in real estate since 2010. I actually got started as a realtor. Seth had sold a medical billing company, and we teamed up. We bought, renovated, and refinanced multifamily properties, and eventually acquired about a $20 million portfolio, now helping over 50 people passively invest in real estate. And we have an in-house management company out of Berkeley Heights, New Jersey. So we're very New Jersey focused. We only invest in New Jersey. We also only manage everything in-house with our in-house management company. So we're completely vertically integrated, and that allows us to keep good control of our assets by owning the management company, making sure they perform, and of course, finding great deals here in the North Jersey market that allow you to generally commute to Manhattan within an hour. That's our recipe for success. So together, we've done 250 transactions plus. We have a nice $20 million portfolio, and we're always looking for the next opportunity and putting together a group of investors for each opportunity. And like I said, about a third of them self-direct their IRA or solo 401k, because we have a very long-term view of real estate, and that works well with the investment strategy of IRAs because they tend to be very long-term. Well, here's our agenda for tonight. Number one, why do people invest in apartment buildings in New Jersey? Number two, why do people prefer a syndicated investment opportunity? Number three, why do people value PCG's service? So again, if you have any questions here as we go along, please put them in the Q&A. I see more people jumping on as the night rolls on. Always good to see so much interest in this topic. And we'll break into these sections here right now. So why do we focus on New Jersey? Well, quite frankly, there's a ton of people living in North Jersey that need a place to live. There's a lack of housing here. There's a shortage of housing. There's more people than we have places for us all to live. And that's causing the price of real estate to go up, which is a pretty common story in a lot of markets right now across the country. So we're seeing out here the wages continue to rise, rents continue to rise very aggressively. A lot of Fortune 500 companies, 20 Fortune 500 companies, number one in drugs and pharmaceutical jobs, number two in direct foreign investments, number three in household median incomes, and number one in education. So a very highly skilled workforce, a very highly educated workforce, high earners here, a lot of wealth. There's also just a ton of people, ton of jobs. And of course, we work off the New York City market, the Manhattan market. But we don't actually invest in New York City. We just focus on New Jersey. We've done very well in Newark, Patterson, Jersey City, Morristown. So our investors enjoy returns from those high demand cities in North Jersey. And we're very locally focused here with our in-house management company out of our office in Berkeley Heights, New Jersey, where we also have in-office events. We're starting to get those going again, which is very exciting. And maybe you found us in our meetup, or maybe you have been to one of our events in the past in our office there in Berkeley Heights or Morristown. Or maybe you just found us online and you had jumped on a past webinar or found our podcast, the Passive Cash Flow Podcast, and found us that way. But we have a weekly podcast, monthly webinars, quarterly events in the office. So we're very active with our network, and hopefully you can participate in all the free content and events we have. So let's continue here. Why do people invest in New Jersey apartment buildings with People's Capital Group? So generally, the reason people invest in real estate is for the legal tax shelters. Now we're talking about self-directing your IRA into real estate tonight, so that's a bit of a wash through. But the main idea of real estate, especially high demand real estate that's professionally managed by a local management company like us, with a local real estate syndicate, the idea is predictability, right? More predictable returns to fund important occasions in life. And that's what an IRA or solo 401k is about, making sure the money's there, the money's coming back into the account properly, and it's backed by high demand assets that continue to produce value and are going to hold demand whether markets are up or markets are down. See, apartment buildings in high demand markets in North Jersey that are professionally managed, people still need a roof over their head, rather than if there's a recession going on or not. So property values do go up and down, but we tend to see consistent demand in New Jersey. And we tend to see, even through tough markets, consistent demand, rental growth, or at least consistent rental demand And that's nice to see in the high demand North Jersey market. That's why we focus on North Jersey, the demand. And our investors are looking for low risk investments. So by having high demand opportunities, professionally managed with the in-house management company, and buying larger apartment buildings and having more units under one roof, vacancies hinder us less, repairs hinder us less, and having that that easy commute to New York, Manhattan within about an hour. And that's a nice recipe for continuous demand through good markets and recession as well. So well-managed New Jersey apartment buildings tend to fare well in recession and keep predictable cash flow coming in, tax benefits, and also equity growth over time. We've tried to focus on doing the cash out refinance, so the majority of the returns are earned through the refinance of the real estate. And that's a nice liquidity event that happens every 3 to 5 years on our properties. And we'll explain the cash out refinance in this presentation and why we execute that strategy, why we're really not usually selling our apartment buildings. Instead, we refi, trade to the 1031. We'll break that out today in the presentation. And that's our strategy. And we really do focus on high demand apartment buildings there with the in-house management company, so our investors can fund important occasions in life, like putting their kids through college, weddings, and just travel, just enjoying more time with their family and their friends, because it's 100% passive investment where you're not running around doing the day-to-day management, managing the management company, or taking the mortgage risk as well. We do that all here at People's Capital Group. So let's talk about buying larger buildings and why bigger is better in real estate. See, it's quite simple. If you have 25 or 50 units under one roof and you lose a tenant or a couple tenants are not paying rent, well, you're still going to be able to cover your mortgage and your costs. And if you say have a 2-family or a 3-family and one of your tenants stops paying rent or loses their job, you're probably going to have trouble covering your costs, especially on a 2-unit property or 3-unit. So we found that small multifamilies really don't cash flow all that well. And in fact, you get very heavily hindered by repairs. So let's say a boiler breaks, it's $5,000 to fix it. That could be your entire net cash flow for the year on a duplex. So by having larger properties, more units under one roof, you have economies of scale. But of course, it's harder to buy those properties because they're millions of dollars. So by pooling capital together, investors can partake in larger properties without putting all the capital in to buy it. And they can get started in multi-million-dollar buildings with as little as $30,000. That helps a lot of people get started with bigger properties with a smaller investment amount. And then the mortgage. So if you ever bought a home, you had to personally guarantee the mortgage. That stinks. That's a risk you really don't want to take on. Seth and I will sometimes personally guarantee the mortgage on these properties. We make sure our investors never have to sign for the mortgage, and that allows us to get better terms on it as well. And so we take the mortgage risk so our investors don't have to, and that's a big investing in real estate to not take that more. We focus a lot on Newark, Passaic, New Jersey, Patterson. We've done well in Jersey City, and basically all throughout the 78 corridor there, Union, Essex, Hudson County area. I see my internet slowed down for a second there. Hopefully you can still hear me and see my screen. If there's any technical difficulties, please type it in the chat. So if you lose me here, hopefully you can still hear me. So number 2, why do people prefer syndicated investing? Syndicated investing, or a real estate syndicate, is when you pool capital together. As I was saying, it allows people to buy bigger properties, which bigger is better in real estate. But it also shifts the risk, so you're not putting in all the capital yourself. And more importantly, you're hiring professionals by doing that, right? Just like how we hire a doctor to get health advice, or of course, a hairdresser to do our hair. We are going to ideally hire professionals when it makes as well. And investing in a real estate syndicate is tapping into expert knowledge, right? Being lifted above the pitfalls by investing with experts. So Seth and I have done hundreds of transactions. We've bought and sold apartment buildings. We've refinanced properties. We've fixed and flipped properties. We've wholesaled. And by doing all this, we've developed a management company as well. And we've made mistakes along the way. We've learned from them. And we developed a nice system, a good infrastructure where people can get invested passively in real estate without having that learning curve and making all those mistakes. And those mistakes can be costly. So we've made those mistakes. And luckily, we've learned through the years and developed a good system, a good infrastructure, so investors value their free time and don't have to deal with the day-to-day headaches of managing real estate. And of course, that allows them to focus on more important things in life, like spending time with family and not dealing with toilets and tenants, as we say here in the real estate business. So a syndicated investment shifts the risks and hire the professionals to take care of your asset, essentially. And once we own the asset, we're going to force equity into the building. So let's talk about forced equity for a second. That means we're doing physical renovations to the property, improving the building physically through renovation inside and out. That's going to allow us to get a higher rent price for the unit and lease out the units for top dollar. That's going to allow us to get more income from the property. The more income we're earning from the property, the more it's worth. So that allows us to do a cash out refinance every 3 to 5 years and harvest that equity growth through a cash out refinance. And I'll break into that in a few more slides. To find the deals, we'll invest up to $10,000 a month, sometimes connecting with landlords directly, getting pocket listings from brokers, wholesalers. Sometimes we'll look at 400 properties just to close on one. We have over 10,000 people on our network between investors and wholesalers and different people throughout in and out of the industry. And the most important things I mentioned keep getting clipped. Hopefully I'm coming back here. Sorry about that. As I was saying, we focus on, it's really the hardest part of our job is finding a good deal. Okay. It's about being direct to the seller, direct to the landlords, direct to the realtors. And that's how we source great opportunities. It also costs money, a lot of direct mail marketing and having a good network over 10 years doing this in this market here. That's why we really focus on North Jersey, because our connections allow us to get off-market deals. And in this business, you make your money when you buy. So it's important to be getting off-market deals and buying them for a discounted price. And that's exactly what our job here is at People's Capital Group. That's what we focus on doing. So together, we've done over a 250 asset portfolio right now, about 150 units. And as I was saying before, we take on the risk of repaying the banks and signing for the mortgage so our investors don't have to. And to make sure we're hyper motivated to hit our targets and make sure we achieve our targets from day one when we're repositioning the apartment building. Okay, so let's break into repositioning apartment buildings and why people value our service here at People's Capital Group. So we have an aggressive calculating business model. We really focus on very good management of real estate. See, I always say you can make money in real estate in plenty of different markets and plenty of different ways. But the bottom line is you want to be working with good managers, good operators that know exactly how to manage that type of real estate, how to execute the renovation, the lease negotiations, the whole process of managing real estate to a T, keeping your costs low, getting projects done on time, being good with tenants, understanding how to work with tenants and putting your tenants first, because a happy tenant equals a happy investor. And just making a good environment, a nice place to live, a good place for your tenants. And that allows us to create more value in the property and create better returns for our investors. So the first step in creating a good value and finding a discounted apartment building is marketing, as I was saying, and cherry picking the best opportunities that have value add potential. Out of hundreds of properties, we'll pick one, bring that to our investors after we do multiple levels of due diligence. We have 3 different levels of due diligence on every property. So we complete all this due diligence for our investors and bring this all to our investor group so they can review all the information. And then we'll pull together capital to buy the property, to give us a down payment, the closing costs of the property, the renovation cost, and we'll manage the property doing a renovation strategy, renegotiating leases, turning over units, getting them leased up for top dollar, working with some tenants, doing cash for keys with other tenants, and overall focusing on respecting the tenant, having a good quality of life in the building, improving the communication with the tenants, and working with some of them to renegotiate the lease amount, or others to have the units open up and have them renovated and released for top dollar, which is basically the whole strategy of repositioning apartment buildings, is bringing the net operating income up by increasing the rent roll on the property. So as we increase the net cash flow on the property, we increase the property value. As we increase the property value, that increases our equity, which is the amount the property is worth minus the debt. Then we focus on doing a cash out refinance after about a 3 to 5 year period. That's going to allow us to essentially harvest that equity growth and split it up amongst the investors. Now, the investors have two options at the refinance time. They can exit, get back their initial investment, exit the investment, or they could stay invested and continue to earn refinance capital every few years from the investment, cash flow as well, and tax benefits annually. But the whole idea here is to stay invested long term. It is a tax-free strategy, especially with an IRA. And the idea here on the refinance is to avoid paying taxes as well. So 9 of our investors decide to stay invested. But the whole strategy is to force value into the property and then harvest that value growth, harvest that equity growth over time, every 3 to 5 years, and split up that lump sum of capital with our investor base that are invested in that opportunity. So we have an aggressive and successful repositioning track record. We've created a management company that's really just focused on repositioning apartment buildings. See, we've hired other management companies in the past that were very hard to work with and really not focused on actually repositioning apartment buildings as we are. We focus on low vacancy rates, high collection rates, exceptional tenant care. We have calculated construction costs that stay in budget. We really try to stay on budget, on schedule with our construction. That's one of the hardest parts of this business. If you've worked in real, whenever renovating a property, to make sure, or repositioning a building, to make sure things are going according to plan. So we only manage our own properties. I see here, oops, my internet slowed down for a second. We only manage our own properties. We stay laser focused on our own properties. We don't manage anyone else's property. So that makes sure we are processing our repositioning every step of the way. And that creates consistent cash flow for our passive investor base. All right, so we'll touch on the exit strategy here. Every 3 to 5 years, investors have two options. When we complete the refinance, they can stay invested, continue earning a passive cash flow from the property on a quarterly basis, a large lump sum upon the refinance every 3 to 5 years, and eventually we'll sell the property and trade into a bigger property, restart the tax depreciation, and of course, bigger properties allow for more cash flow, more equity growth. So we have a very long-term view of real estate. You can build with us through the years here in this high-demand market in North Jersey with People's Capital Group, or you can exit the investment. Every 3 to 5 years, we do a refinance, and you can invest back your initial investment. That allows, but really we have a long-term investment strategy, a long-term view of investing in real estate. And 90% of our investors share that view and decide to be invested long-term. Also, most of the time we're hitting higher than targeted. So since we do better than targeted, often most of our investors decide to stay invested long-term with us. Together, we've actually pooled about $7.5 million. Our minimum investment amount is $30,000. The investment time is 3 to 5 years, and there is a qualification process to invest with People's Capital Group. You have to be a sophisticated investor as defined by the SEC, or an accredited investor. If you're not sure what those mean, you want to go to peoplescapitalgroup.com. We have definitions there and how to qualify as well. We also have our podcast, other webinars, tons of blogs and information there at our website, peoplescapitalgroup.com. But there is a qualification process, so you'll want to go there to learn more. But let's go over some case studies here. We're going to talk about a few properties one we bought and still own today, another one we bought and sold, and another one we refinanced just now and did very well with. So here's a 5-unit property in Newark, New Jersey. This is a smaller property. It's just a good example of the buy, renovate, refinance strategy. We were able to refinance this building within the first year of owning it. We bought it for $110,000. We put $30,000 in renovations into it, very small amount. And really at the end of the day, for that big a property to put renovations into. And we were able to refinance it in a year, and it appraised for $310,000. So that allowed us to do a cash out refinance. And we then reverted to a different split with the investor in this case, so the 20/80. Normally on most investment opportunities, we're more around 2/3 of the investor group, 1/3 the People's Capital Group. But in this case, we had a bit of a different structure, and we were able to refinance within 1 year, get entire investors' investment back, and then we refinanced again in 2017, split up a nice lump sum of capital. And that property continues to cash flow a small amount. And that's actually a nice high demand location in Newark, New Jersey, near Rutgers University. So small building, but a good example of the cash out refinance, and it could be the gift that keeps on giving as the property is professionally managed and continues to be leased up. I think the rent has doubled since I bought it. So really phenomenal investment for us there at People's Capital Group. So here's a 25-unit building in Paulsboro, New Jersey. They were asking $1.2 million. We bought it for $1,075,000. And in this building, we captured about $125,000 equity from day one. And that allowed us to buy the property at a discounted price. As they say, make your money when you buy in real estate. We secured a bank loan at 75% of the purchase price at a 4.5% interest rate. Our private investors came in with about $100,000 each, and we had a 60-40 split with the investors, and that allowed us to do a nice equity split here with the investors, bringing in 4 investors. It's not always that clean. Sometimes we have investors at $30,000 minimum, than others with $300,000. So it's always a little different like that. In this case, we had 4 investors equal to $100,000 each, and we did a 60-40 split with PCG owning 40, the investors owning 60. We were able to sell the building about 2.5 years later for a nice profit. Sold it for $1.35 million. The reason we sold it was we got a good offer, but it was also in South Jersey, so we found the management a little bit harder since it was for about 90 minutes away. But we were able to achieve about a 10.5% annualized cash-on-cash return for our investors here. So we achieved our goals. We were able to exit the property nicely. We just refinanced a 6-unit where we earned about a 16% cash-on-cash annualized return for our investor there. And that allows us to earn sometimes the market as strong as it's been, and our management system in place, it allows us to often hit higher than targeted for our investors. So we try to achieve around a 10% annualized cash-on-cash return for most of our investments, but lately we've been overperforming, which is always good to see, and our investors have been enjoying that as well. So let's talk about self-directing your IRA here, and we'll just touch a little bit more on what Brittany had explained. So you can self-direct your IRA into real estate. Of course, there's disqualified members, but in our case with People's Capital Group, we are not disqualified. We are IRA friendly, as long as I'm not your son or or a disqualified member or your financial advisor, right? But so as long as I'm not a disqualified member, you can invest in real estate with People's Capital Group. You can self-direct your IRA into it. Of course, you want to work with an IRA custodian, so you would call up Next Generation Trust and you'd say, okay, Brittany, I'd like to start an account, set up the account there. Of course, you explain the process of self-directing your IRA with Next Generation Trust. Then they would review our documents for the investment opportunity. And once approved, wire the funds over to the title company doing the closing on the property, which would hold the funds prior to closing. Once we close on the property, there's cash flow to be earned. And once those checks are flowing back to the investors, that's going to go back to your IRA custodian. So it's not a way to pay yourself first or get around the IRA rules, but it is a way to build your IRA faster. And of course, when we do the cash out refinance, that big lump sum of capital is going to come back to your IRA custodian. And about 9 out of 10 of our investors also take those earnings and eventually reinvest in People's Capital Group as we come up with new opportunities at that time. So it's a pretty simple process. It's only a few $100s to do it. It takes a few weeks, depending on really the custodian and also where you're moving it from. And it's a pretty simple process. So we really enjoy doing with Next Generation Trust. We suggest you do it with them. And we are IRA friendly. So also Solar 401k friendly as well, which your IRA custodian can guide you a little bit more about. And real quick here, we have a couple different types of investors that we focus on. And we like to focus on accredited investors. That's one type of investor we focus on, or a high income earner. This is someone that generally has a high W-2 income, maybe a doctor, and they're getting hit on taxes very heavily. So if you're earning a good amount as an operator yourself, doing whatever you do and make a high W-2 income or high 1099 income, you may be taxed very highly. If that's the case, you want to have more tax shelters, especially with the investments you're making with that capital. You don't want to get taxed again on those earnings. So the idea with real estate is to have more of a tax shelter. Of course, if you're self-directing an IRA, you already have that tax shelter. But we do feel that real estate is a great place to diversify out of the stock market into real estate. Not only are the tax benefits, but it seems to be a little more predictable than the stock market, less volatile, and also a little more recession resilient if properly managed and invested in the right areas, as we focus on in North Jersey. There, we feel those high demand markets are pretty safe bets in the long run as far as continuous demand in your assets. And that's what we really try to focus on. We also like working with active real estate investors. These are people that are managing their properties day in and day out. Maybe you own a property or a couple condos or a multifamily that just isn't cash flowing as you had thought. Investing in a syndicate can allow you to learn from real estate professionals, make better returns, getting into a bigger building, not having to manage the building day in and day out. And of course, tax time is a lot easier as well, as our CPA issues K-1 tax forms quickly and effectively at the end of the year. So our investors get those documents quickly at tax time. And of course, an IRA investor, this is the third type of investor we love working with. Self-directing your IRA into real estate. Like I said, about a third of our investors are self IRA accounts. It allows people to diversify out of the stock market properly. We also like what people really enjoy about self-directing their IRA into real estate is what I've seen a lot of our investors say, I really like investing in inner city areas with People's Capital Group. So we allow people to make a small difference in inner city areas. We're buying mismanaged properties. Maybe they were managed by a slumlord before, but we use People's Capital to renovate these buildings and make a small difference in that neighborhood, in that building, and making the landlord as well. So being able to move your IRA into the inner city communities, renovate a building in those areas, improve the area, make it safer, make it a better building, a nice place to live and raise your family, then it's really making a difference in those inner city markets. And even though it's a small difference, people like doing that with their IRA. And it's a little bit different than owning, say, a mutual fund or just a general a stock that you're really not, you don't see that tangible difference. There is tangible impact when investing your IRA in an inner city community. Maybe you grew up around Newark, New Jersey, or Paterson, New Jersey, or Jersey City, and maybe you know these cities, and you're like, yeah, I would like to own a building and improve a building there, not have to do all the work day in, day out, but it's a nice idea to be finding a mismanaged building that maybe wasn't such a great place to live when we buy it, and then making it a nice place to live and just having that positive impact on that one corner of that community. That's really nice to see, and that's nice to do as an operator. And I know for a fact a lot of our investors say, hey, I love self-directing my IRA into your deals because I make a difference in an inner city community, and I really like that, Jersey. But hopefully you learned a lot from tonight here at People's Capital Group and our presentation on how to self-direct your IRA into real estate. You go to peoplescapitalgroup.com to learn more. We have a podcast there. We actually have a webinar that we do almost every month here, the IRA webinar. And here's our website here, tons of stuff. We have frequently asked questions, a blog, we have our podcast we do every single week. We have an ebook as well. And you can go enjoy all this information here. And then if you are ready to move to the next step and find out if you do qualify to invest, there's a button to click here. You can fill out a basic form and we'll get in touch with you. You can set up a call with me, Aaron Fragnito. We'll talk more about your investment goals, figure out if you're qualified to invest in People's Capital Group and if our interests align. And if so, we could talk about opportunities we have on the horizon here at People's Capital Group, and perhaps even allow you into the investor community here that we have at People's Capital Group. So hopefully you enjoyed our presentation tonight. Thank you so much for joining us. I'm going to pass it off to Brittany here. She can conclude for the evening. And I think let's see actually if we have any questions here. Okay, yeah, sorry about the crappy connection. We have a storm going on here, and it seems now I have
cutting out again.
Maybe you should take over, Britt.
Yeah, I was just gonna say, I think we'll get him back eventually, but yeah, we powered through that. Thank you, Aaron. Yeah, so just, oh wait, there he is. No, maybe not. Well, I'm sure for anyone who's on right now that Aaron will have a copy of the recording to share with you and is available to chat further.
Oh my.
There you go.
I really blew it.
No, you're good.
Oh boy.
I think
Okay.
we're in the age of anything goes these days, so everyone understands virtual life.
Yeah. All right, go ahead, Brittany. Wrap it up here.
No, I just wanted to thank you again for allowing us to share some of the SDIRA education. You made a lot of really good points, and another one that I thought of when you were talking is that not only are we in uncertain times, but we're definitely in an inflationary period right now. Inflation rates are crazy, and they've outpaced even what the projections were. And real assets like real estate and natural resources tend to bode well during inflationary periods. So not only when we're talking about recession, but times of inflation, these asset classes tend to hold up well. So that's another thing to think about, because I know there's a lot going on at the markets right now. There's a lot of up and down. So something for people to think about as part of their portfolio. But again, thank you for having us. We're happy to provide more information as needed, and just here to support anybody that's looking to, take a little bit more control of their financials. So.
Awesome. Thank you, Brittany. Can you hear me now?
Yeah, you're good.
Oh, excellent. Excellent. All right. Well, I got a small window here. Yeah, big storm tonight. So I guess that's affecting my internet. But anyway, yeah, so pretty choppy, unfortunately, but we'll send out the recording to everyone who joined. And that'll be hopefully a good recording, and you can fast forward through the choppiness. But thank you so much for joining us tonight. Thank you, Brittany and Jack, for coming out as well.
My
And
pleasure.
we're glad to talk about how you can self-direct your IRA into real estate. Absolutely. Fun topic.
Awesome.
All right. Have a good night. Enjoy yourselves.
Thank you, Aaron.
Thank you.
Thanks so much. Bye, everyone.
Bye.